We're talking today with Calema Energy, and in particular, the Managing Director and CEO, Jordan Keevil. Jordan, good to have you on. You've had a lot take place inside Calema since the acquisition of Blackspur. You've recently consolidated your shares on a 20-to-1 basis. Is that the final step in terms of implementing Blackspur into Calema Energy?
Yeah, I would say it would be the final step. As you recall, the deal between Blackspur and Calema closed on April 30th of this year. And after raising $38 million back in April of this year, we had about 10.2 billion shares outstanding. So we've recently completed a 20-for-1 consolidation or reverse split. And we've now got approximately 513 million shares outstanding. Market cap still just right around $100 million. And we've been trading in the 18 to 19 cents per share range post-consolidation.
Now, Jordan, Calema Energy is based in the Montney Basin in Canada. Can you talk to us about how active it is out there at present?
Yeah, and one of our, we have three core areas. We have our Montney area, and then we also have our Brooks and Thorsby core areas. But in the Montney area in particular, there's been quite a bit of M&A as of late, and a lot of that M&A activity has been in and around our existing Montney land base. So we've been watching that very carefully, and we've been evaluating our options. And as we've mentioned before, we're looking to either potentially seek some alternatives for the Montney that may include a partnership, a farm out, or potentially even an outright sale of that acreage. So in the coming weeks, I think we'll have some more guidance to the market as to what our plans are for the Montney acreage in northeastern BC, because we know there's a lot of value in that acreage, and we are looking for ways to help unlock it for our shareholders.
And Jordan, can you remind investors how leveraged Calema is to the oil price at present?
We're very leveraged to WTI oil prices. As you may recall, we have a very low break-even cost for our barrels here in Canada on our acreage. It's $26 WTI, which is our break-even cost. So we can produce our barrels all the way down to $26 WTI US and still be in a positive cash position. That's also related very much to our low operating and transportation costs. The costs related to our production, or the lifting costs, is about $10 to $12 Canadian per barrel. So it's the low operating costs and the low break-even costs that help give us a real torque to rising oil prices. And in fact, at $70 oil, at a 3,300 BOE per day rate, which is approximately what we're at right now, we're going to have $41 million of EBITDA at $70 oil and a 3,300 BOE per day production rate. Then next year, our current guidance of 5,500 BOEs per day in 2022, if oil just stays flat at $70, that's $68 million of EBITDA next year at 5,500 BOEs per day. Then that torque, if oil happens to go up to $80 in 2022, that $68 million becomes $83 million of EBITDA in 2022 at 5,500 BOEs per day and an $80 oil handle. So we're very pleased where oil is right now because we're very profitable at these prices. And if oil happens to keep going up over the course of the next 12 months, that's even more torque for us and the shareholders.
From a leverage perspective to the oil price, can you highlight some numbers in terms of a month-to-month basis, what that rising oil price actually means?
Yeah, well, for example, in July of this year, we had about $5 million Australian of revenue for the month. And of that, $2.5 million of operating netback for the month of July. We actually realized $74 per barrel Canadian for our oil in the month of July. So these strong prices are really translating into some serious revenue for the company. And also rising production rates. We increased production from June to July by 400 BOEs per day. So it's a really good combination of rising oil prices, rising revenue for the company, rising production. Everything is just pointing up. So that gets us really excited for what's upcoming in the future.
Now, Jordan, oil and gas has been out of favour. There are quite a few companies listed on the market that are probably trading below valuations, possibly Calema included. What does that sort of cash flow in terms of where the price of oil is relative to your break even? What does that mean for shareholders potentially moving forward?
Well, I think what that means for shareholders is there's going to be just increased value and increased optionality for these companies that have clean balance sheets, go to oil properties, as well as at the high torque to the oil prices, as mentioned. As we continue to grow our production and oil prices continue to be strong, I think eventually shareholders are no longer going to be able to ignore these oil companies that have free cash flow and are in positions to either start returning capital to shareholders via dividends or performing share buybacks or just increasing capital programs with their free cash, drilling more wells, growing the company, and it just snowballs from there. So I think that as time goes on with oil prices remaining strong, there's going to be some renewed interest in the oil patch with respect to these stock prices.
And Jordan, what does the timeline look like forward for Kalima?
Well, currently our production is around 33 to 3,500 BOEs per day, but as has been recently press released, we just finished our second of a 3-well drilling program in our Thorsby core area, known as the Leo drilling program. We've got 3 Sparky formation wells that we're just finishing up drilling in that area. Those wells are scheduled to be fracture stimulated as part of the completion process and tied in and brought on production as early as mid to late October of this year. So the result of the production from those wells is what's going to drive us from current 3,500 production to an exit of 4,500 BOEs per day by the end of the year. And then we will next year begin drilling wells right away at the start of the year and on our way to our 5,500 BOE per day guidance for 2022.